The market is relatively unchanged today. You can see the big dogs, Nvidia, Apple, Microsoft, Google, Meta, all the big tech, relatively unchanged. So in this video, I'm going to go through two valuations for Nike and ASML, and these were viewer requested stocks. So I'm going to do a stock valuation analysis on these stocks, see what the fundamentals are, you know the drill, the moat, and see what news and sentiment is around the company, and then do a stock valuation on both of these companies. So I'm going to wrap up this video with some of the news articles that I saw. And these are going to be part of my ongoing series, like a weekly recap. Every Friday, I'm going to try to push one of these out. And if you like this content, please like and subscribe, and then let's get straight into this. Now, if you look at Nike, you can see that they're going to report earnings on 30th, which is in 4 days, next Tuesday. And the first thing that strikes out to me in their chart is they reached a bottom around $52. And since then, they rallied strongly. They rallied really strong and made a fair value gap on their last earnings. And so they beat on revenue and earnings here. And then they jumped up all the way to 80, and now they're trailing down to about $68, $69 a share. And it could go either way. But let's go into their business model and talk about that a little bit. Now, on their investor relations page, they claim that they're a growth company. They partner with athletes and celebrities to offer a product line that is catered to winners, and that is how they differentiated themselves from other apparel brands. So now let's look at their shareholder letter and see what they're saying, what the CEO is saying about their company. Like I said before, they are all about the winning culture, which really sets them apart from other companies and other apparel brands. And so they're getting back to that. They're saying that they're shaping their brand for distinction. There are several sport events that they were a key part of: the Super Bowl, NBA All-Star Weekend, the Masters Championship, the Champions League Finals, the French Open. And they're looking ahead into 2026 with the World Cup on the horizon. And they're going to upgrade their 3 Nike football boot silos in a 12-month window leading up to the World Cup. So they're going to really drum up excitement around this and tie it to the World Cup. They're also elevating and growing their marketplace. They're saying that they've made progress in returning Nike Direct to a more premium destination, especially when tied to a sports moment, a key product launch, or an on-the-ground activation. Our teams are also focused on co-creating growth plans by brand and by sport, because they're in all of these different sports and tied integrally to those sport and sport events. Investing in the presentation of our assortments and ensuring that we are adding points of distribution to be in the path of a wider range of consumers. So they're trying to grow their total addressable market and consumer base, as well as, target these events and activations. But they're also saying that you can see that these investments and things to grow their business is going to put pressure on the near-term result. And you're going to see that in the results here. But here they've saying that for fiscal year 2025, our revenues were down 9% on a currency neutral basis, and our EPS was $2.16. With the changes we are making this year were necessary to create a strong foundation for the long-term profitable growth. So they expect to get to long-term profitable growth. They're going to see an acceleration in that long-term profitable growth by doing these things now. They're kind of biting the bullet now to, grow in the future. So speaking of their results, let's look at their last fiscal results. Their fiscal year ends in May, so they've already reported their full year results in May 2025. So here you can see their consolidated statements of income. You can see that their revenues went down -10%, like they mentioned in the letter. Cost of sales -7%. Gross profit -14%. Overall, their net income was -44%. And their diluted earnings per share was $2.16, like we saw in the letter. And that is a change of -42%. So not great results from Nike. And you saw this in the shareholder letter. They're saying that there's near-term weakness for the next maybe a few quarters because of these investments and their efforts to get to long-term growth. Their balance sheet, you can see here, their cash and cash equivalents went down negative 24% year over year. Their total current assets went down 8%. Total assets changed negative 4%. Now let's go to the divisional revenues. So they've segmented out by geography what their revenues look like across the world. And so there are key points here that I want to take away. And one is that the footwear in Greater China is showing a negative 21% change. Apparel is negative 19% and equipment is negative 35% change. And so this is pretty interesting because this may have to do with the tariff drama around US and China, and also just overall geographic weakness in that area. So let's move on to the news and sentiment, and let's see if we can get greater clarity around these results and why there's such short-term, near-term weakness here. So the first thing I want to go through is this. Nike says that its tariff bill is $1 billion. So if we go through this article, we see that Nike is forecasting to have to pay $1 billion in additional costs because of these tariffs, and it represents a new and meaningful cost headwind. So how are they going to combat this? They're going to have to raise prices on their products, which may or may not affect their demand for those products. Okay, so here they're saying, although China remains important to our global source base, the company is reducing the imports of footwear to the United States from about 16% to the high single-digit range by the end of fiscal 2026, with the supply coming from other countries. The impact of tariffs and decline in consumer spending was especially pronounced on its net income for the fourth quarter, which fell 86% to $211 million, a sharp slump from the $1.5 billion it reported a year earlier. Despite the drop, they plan to aggressively right-size 3 very important franchises, including the Air Force Ones, Dunks, and Air Jordan labels. Yeah, you can see that these tariffs are they are relevant to Nike's brand and business. Here's another article that's more recent than the one I showed. And here it says Nike remains a buy, supported by a 17% upside, confidence in ongoing turnaround and management changes. Key focus areas include China sales, inventory management, and impact to US tariff policy on margins. So that's what it's hitting. It's hitting their margins because of this tariff policy. They can still sell, but if your margins are suffering from these tariffs, then it's not going to look great. Historically, China was Nike's sales growth engine. However, this was left behind as reference. Yeah, here they're pointing out the negative 21% annual drop in sales to China, as I did. And the reasons are diverse: competition, national products, changes in habit, profound turnaround process called Win Now. And we saw that in the shareholder letter. So their strategy to mitigate tariffs, this is huge. So they're going to probably increase the prices of their products and other strategies to reduce the price. So changing the production pipeline from China to other countries is one way to mitigate costs, and also increasing the price on the products is another way to mitigate the costs of the tariffs. Okay, so let's move on to my stock valuation software and look at Nike and see what they're saying here. So the PE ratio right now is 32, shares outstanding 1.19 billion, forward PE is 41.67. So there's going to be acceleration in the PE. Hopefully that's due to earnings increase in revenue growth and earnings growth. Hopefully. They have a forward dividend and yield of 2.2%, which is really good for income seekers in the market. First things first, let's go through valuation. And obviously there's several ways to evaluate a company. Here is the DCF model, and my software will figure that out for you. You have to understand one thing: their fiscal year ends in May of that year. So this is really 2026, 2027, 2028, 2029, and 2030. There was a negative 0.8% revenue growth based on the trailing 12 months. And here, analysts are expecting a 5.6% increase in revenue growth, not a large amount. You can see that you get a fair value of $78.21. So that is good. It's not like groundbreaking or life-changing money that you would get if this went to its fair value, but that's always a nice increase in share price. So moving on to multiple of earnings valuation, you can see that here, based on the net income growth and net income from analysts and the EPS growth from analysts, you see that they are projecting is around the same price for 2025, 2026. But if we change this growth and net income growth is not going to be 47.2% in the following years, let's say 20 for all of these years, 20%. And then let's bring down this to 25. Seems reasonable. So you're seeing a 2027, 2028, and 2029 multiple of earnings valuation of $76, $91, and $109. So that is a nice increase from the $69 that it is currently. It is up to you to determine if that amount of potential gain is worth it. There are other companies out there, the big tech companies that could post bigger, and AI companies that could post bigger gains than that. But let's look at analyst forward estimates. Analysts are estimating $79.57. That's based on the average of 39 different analysts. So for that, they're saying 15% undervalued at the current price. Historical price to earnings ratios. Right now it's 32.1x. And you can see that the price to earnings has gone down with the price of the stock. You can see it got all the way, when it was in the 50s, it got all the way under 20. So this is a little bit elevated, and based on what I saw in the chart and know about their low earnings and low revenue growth right now. Price to sales, 2.3x. Price to book, 8x. So yeah, that's relatively higher than what it has been. And I would love to get that under some of these lows, but we'll see if that happens. Now, here I have earnings and revenue growth forecasts. And you can see here I have revenue, earnings, free cash flow, and cash from operations. And the split between past data and analyst future data. So you can see that ideally, there's going to be a slight ramp up in the revenues, going from 46 billion to 48 billion. And the others are trailing, but it's not groundbreaking growth here. Then we have EPS growth, and you can see that overall, if I look at the quarterly data, you can see overall, the vast majority of EPS reports have beaten analyst expectations. The green line is the actual, the blue line is analyst expectations. And more than their actual analyst consensus too, which is the Ichimoku cloud. But you can see that in the past few quarters, they really actually nosedived below the analyst expectations. So they kind of missed on that because of the reinvestments and stuff. But hopefully that can pick up. This is a new feature I put in. It's a Sankey chart. And the Sankey chart tells you how it breaks down. So they start with their revenue streams on the left, that 46 billion for current year, and how that breaks down into cost of sales and gross profit, which goes, the gross profit goes into their expenses and earnings, and then the expenses go to sales and marketing and general administration. So this is really useful for looking at different years, and you can even show the difference over time. Overall, based on this, I would love to get some shares of this company at a lower price. And I think it's possible if their earnings report fails to impress investors and retail investors. So I'm thinking closer to $60 will be a better buy for this. And we'll have to see if they are able to, if that happens with this latest earnings report. I'd be very interested to see their price to earnings after the earnings report and see if that fair value gap is closed on the chart. So now let's move to ASML and look at their business model and their results, and then go through a stock valuation through using the software. So you can see that ASML reports 7.7 billion in euro total net sales and 2.3 billion net income in Q2. Full year 2025 expected total net sales growth of around 15% and with gross margins of 52%. That is great revenue growth and gross margin growth. So I'm really excited to see that. And that goes into the thesis of why I started buying shares a while ago and DCAing into this company. Let's look at their key messages from their investor presentation. The semiconductor industry remains strong, driven by artificial intelligence adoption across an expanding application space, and is expected to surpass $1 trillion in revenue by 2030. And there's a lot more market share available to take. The industry will require major innovations to address AI power consumption and cost challenges. Our customers remain at the core of our strategy, and we believe lithography will remain a part of their innovation. We see an opportunity to achieve 2030 annual revenue between approximately 44 billion euro and 60 billion euro, with a gross margin of between approximately 56 and 60%. Amazing gross margins that they are anticipating in 2030. We expect to continue to return significant amounts of cash to our shareholders through growing dividends and share buybacks. That is exactly what you want to hear as an investor in this company. You want to see buybacks, share buybacks, and cash returned to the shareholders. Let's go quickly through the consolidated statement of operations, the cash flow statement, and the balance sheet. So here we see that total net sales was almost 7 billion euros. This is all reported in euros. Total cost of sales, negative 3.56 billion. Gross profit, 4.129 billion. Income from operations, 2.664. Income from before income taxes, 2.688. Net income, therefore, is 2.29 billion euros, which is a diluted net income per ordinary share of 5.9 euros per share. The balance sheet here, you can see that they have 12,735 billion euros in cash, and their total current assets are 30.737 billion euros. Total non-current is 17.85 billion. And then their total current liabilities is 18.616 billion euros. Total non-current, 8.614 billion euros. Total liabilities is 27.23 billion euros. So therefore, their total liabilities is less than the 44.849 billion euros of total assets. And then shareholder equity then is the remainder, which is $17.618 billion. Cash flows, net income, they're taking the net income, 2.29 billion euros, provided by and used in operating activities, 747 million euros. Net cash provided by or used in investing activities is negative 428. Financing activities is 2.163 billion. Net cash flows, so therefore is a negative 1.844 billion. So cash and cash equivalents at the end of the period was 7.243 billion euros, which is a decrease from at the beginning of the period was 9.098 billion euros. Look at some news and sentiment around this company. And a news article that I saw recently, very recently, is that ASML is taking a major stake in AI firm Mistral, valued at $14 billion. And so here you can see ASML pumped 1.3 billion euros into Mistral's AI's 1.7 billion euro funding round as lead investor. The Dutch chip giant gained 11% shareholding in a French company on a fully diluted basis. The investment round, which was previously reported by Reuters, more than doubles Mistral's 5.8 billion euro valuation achieved last year. So this is really interesting because it is showing that the policies of the US with regards to a lot of different things in trade and the economy have kind of rubbed off on each of the other countries, China, Europe, and now Europe is trying to end its reliance, or at least minimize its reliance on Silicon Valley. So they're getting all these chips from US companies, but now this European AI company can get its chips from a European manufacturer. So that is a time where European Union is pushing for its AI movement to stand on its own feet and faces the protectionist trade measures of the US administration. So next, here is the article about this author is showing that the market is finally giving ASML its due props. And what they're saying in a summary is ASML has rebounded sharply, getting closer to 1,000. Yeah, right now it's around 953, 954. As optimism finally returns to its AI and EUV growth prospects. Recent positive developments at key customers, Intel and Samsung, and robust AI infrastructure momentum have revived confidence in ASML's long-term outlook. EUV sales outlook will be key in determining subsequent upgrade in ASML's valuation, or it's no longer undervalued, That's what this author thinks. The recent surge in ASML has lifted it into overbought territories. If you want to load up, consider waiting for the next pullback first. So this is what the author is saying here. We will have to run the valuations through our software valuation tool, but let's look at what else they're saying here. And to give you an idea, ASML has increased a lot in the last month and a half. So if we were to do a measure of this, let's see. Right now, it's sitting on about 40% gains since the August lows. So that is a huge increase. I do agree with this author in the summary notes that if it does pull back and maybe fill some of these gaps, those are great buying opportunities, because long term I see this growing a lot. And you can see in their statements and their guidance that they're saying even by 2030, total addressable market could exceed 1 trillion, and their gross margins could be 56 to 60%. So those are really high numbers, and if they are able to achieve that, any pullback, any investment in these pullbacks would be richly rewarded, in my opinion, not financial advice, of course. So let's move on to the valuation of ASML in the stock valuation tool. Here, I pulled it up. You can see that it's automatically converted the euros to dollars in this, so we don't have to worry about that. PE ratio is 33.45, trailing 12-month PE. Forward PE is 31.15, so a little bit of deceleration there. Shares outstanding 393.2 million. It has a dividend, which is very nice, of 0.78%, and the 1-year price target from analysts is 852.9. That indicates there's still some downside here from the 952. You can see here that the analysts have put 14.1% and 4% for the subsequent year. This ends in December, so this is as is, 2025, 2026. So here, let's say the revenue growth is 15% across 2027, 2028, 2029. That's giving us a fair value of $833.40. So based on just this metric, it does seem fairly valued to slightly overvalued in this space. So yes, I would wait for any type of pullback in this name, just based on this, to start accumulating shares. This is the time to accumulate. This was, 2 months ago. So multiple of earnings valuation, let's look at this. So analysts 43.6% since the last year, and then 6.3% 2026. Let's pop this up to 10% net income growth. And let's bring this down to 25, which is pretty reasonable. It honestly should be more. Let's just keep it like that. That gives us a 870 in 2026, a 945 in 2027, a 1040 in 2028, and 1144 in 2029, which is higher than the current prices in 2029, but still not exceedingly so. Analyst forward estimates is 1168, and that's based on 43 analysts, and that is their target. So They're close to this 2029 valuation, multiple of earnings valuation. Historical price to earnings ratio, the current price to earnings ratio is 39.1x, and that has risen sharply as a result of the price going up. But traditionally it has been around that level, and only since April 2025 has it been depressed. But right now it's trading at a premium. Price to sales 13.7x, price to book 21x. That's pretty expensive. So yeah, this is a little bit stretched right now in the short term. Earnings and revenue growth forecast, you can see that it is projected to grow. And right now we're looking at 39 billion in revenue. 2025 full year 44 billion, and 2026 46 billion. A crazy amount of increase. You're not seeing a exponential increase, but relatively steady increase in earnings, revenue and earnings. So we'll have to see what happens in the subsequent quarters. Then you have their revenue and expenses breakdown. Revenue 44 billion, and cost of sales, they break it down into expenses and earnings, sales and marketing, and research and development. I would definitely wait to purchase any more shares in this. Even DCAing, I would wait to get a better valuation on this company. It has been stretched. I want to take a beat and focus on some other companies that I think are better valued at the current moment. This is still a great company, and it still will grow massively into the future. So I will be waiting for a better opportunity, better entry points for DCAing into this. Finally, let's go into some of the week's news. So today came out that the Dow rises 300 points after inline PCE inflation report, and that was widely expected. So the Dow is rising on that, expectancy, that certainty. It's not a wild change or anything like that. So you saw in the heat map at the very beginning that not much has changed, and that's the story of today. The key thing here is that markets continue to price in 2 quarter-point rate cuts for the rest of the Fed's meetings. That's what's been baked into the stock market. Yesterday, there was jobless claims tumbling to 218,000, which was well below estimate despite fears of labor, the labor market weakness that everybody's been talking about. This is down 14,000 from the prior week's upwardly revised figure, and significantly less than the consensus estimate for 235,000. Gross domestic product GDP posted a gain of 3.8% in the second quarter, up a half percentage point from the prior estimate, due to our upward revision in consumer spending. So this is very interesting because usually you've been seeing, for the past few months and quarters, you've been seeing downward revisions in everything. So this is the first time I've seen in the recent time that there's been an upward revision in something. So that's good to see for the market and the economy as a whole. And there's also talk of a government shutdown. And I think this is really a nothing burger for long-term investors. The S&P 500 may fluctuate a week before this shutdown and a week after this shutdown a little bit. But overall, if you're a long-term investor, this doesn't really matter. The government will always get reinstated at some point, and the markets will go back to functioning as they do. So I wouldn't worry about this if you're a long-term investor. If you're a trader, different story. You might have to take some actions with that. But as a long-term investor, I'm not concerned about a government shutdown. And that's it, guys. Thank you for sticking with me. This was a long one. If you like this content, please like and subscribe, and I will see you guys in the next one. Thank you.